Hello, my name is Eddie Tofpick. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Chicago wheat, Chicago corn and Kansas City wheat. However, before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production, or recognition of any of these patterns, levels, analysis, or any related items on these, my charts. This was all authentic intelligence, all my own original work, as I think you deserve to have that. So with that, Chicago wheat. The dominant pattern here has recently shifted from the mid-February to mid-June bearish shift pitchfork to the bright green upper trend line, currently at 549, of the significant longer term pattern, one which I described 5 weeks ago when I said, and I quote, "There was something that came to light by my looking at the longer term charts for my annual review earlier in January. It is a March/October 2025 to date bright green descending triangle pattern, which you can see on my daily chart, highlighted in bright green. That's currently 512 to 549, end of quote. The break above the bright green descending triangle pattern 2 weeks ago led me to consider naming some very, very long-term targets. We'd have a primary target X2 up in the 626 area with a secondary, much harder to reach target, which is actually up off the top of my daily chart. Well, it was originally, it's going to have to put it up there now. And that's in the 668 area. These are a lot closer this week than they were last week, which is an understatement. I also said some very salient points last week, and it's a long but valid piece even now, and I quote, "There are also some other things to consider. The early November 25 to February 26 action is a dish or rounded bottom pattern. This gives us some separate targets of a primary target X3 up in the 603 area, with a secondary harder to reach target X4 up in the 622 area, right on the 50% Fibonacci line, the May 24 to May 25 move at 622 and a quarter. Now, on another more recent action is the bull flag formed over the last 2 weeks, and that's now 3 weeks. This pattern gave us a primary target at 584, a target already reached, and a secondary harder to reach target X5 up in the 608 and a quarter area. Then there is my final point, and again is something I saw from my longer term monthly charts earlier in January. It is a May/July 23 to date bear channel, highlighted in purple on my daily chart. The lower purple bear channel line is below the bottom of my daily chart, but you can see part of it in the lower left hand side of my daily chart. Incidentally, you can actually see the last bit of this there, peeking at the bottom of that left corner of the daily chart. The upper bear channel line is closest today to the market, and it's currently at 619 and 3/4, and that's the end of the quote. Well, today we're even a lot closer, and I mean now challenging today that upper bear channel line, as you can see by the market's movement higher. This brings me to my final point today. It's an old technical analysis technique, but one which I recall worked well in the grains during the start of the Russo-Ukrainian war back earlier this decade. And that is doubling, tripling, or even more of bull channels. In this case, specifically the late January to mid-February bull channel, and that's currently at 554 to 580 and 3/4, which doubled up becomes 580 and 3/4 to 607 and a half, and which capped the market last Monday. Now tripling this higher, 607 and a half to 634 and a half gives another topside resistance above the purple upper bear channel line, should that get broken. I would additionally point out a pair of 50% Fibonacci resistance levels above the market. 150% Fibonacci line I've already mentioned is up at 622 and a quarter, and we have another higher up, the 50% Fibonacci line for the March 24 to May 25 move at 651. Chicago corn. I've said here repeatedly about the market, above the market sits the 50% Fibonacci line for 2025 at 454 and 3/4, which, and as I've already said here repeatedly, and I quote, looks a seemingly formidable resistance because just above that is a very shallowy bearish bright red lower trend line, currently 455 even, to the July 23 to January 24 descending triangle. End of quote. Well, this is no longer true. As though yesterday these two resistances did manage to cap price as much as they did in November last year, and again in between Christmas and New Year, and once again in early January this year. Well, today they have given way to a surge higher. The latest move higher was formed from the market utilizing as a base and as I said 10 weeks ago, and I quote, the important 50% absolute Fibonacci line at 425, which in turn led to the October low at 425 and a half. End of quote. Now I continued when I said, and again I quote, prices seem right now to be willing to just hold and maybe test the result of the overhead seemingly formidable resistances. End of quote. Well, they have. And since actually that last quote, the gold long moving average, currently at 431 and a quarter, has also acted as a base of action. And even more recently, the November 2020 high at 439 and a half. Now, I had previously thought that the whole of the mid-January today action might be a possible bear flag. But 2 weeks ago I shelved that idea because if it was going to happen, then it should have done so before now or before then, 2 weeks ago. Instead, we had an early 2026 based bull channel, currently 438 to 450, which yesterday we broke up and out of. Now, this brings me to my next point. It's an old technical analysis technique, but one I recall working well in the grain and starch markets during the start of the Russo-Ukrainian war back earlier this decade. And that is doubling, tripling, or even more of the bull channels. In this case, specifically, the bull channel becomes doubled up, which is currently 450 to 462 and a quarter. And that's been roughly, just short of the high. 462 was the high today, so it has capped the market today. In addition to this, I've drawn a new dark blue bullish shift pitch hook for the mid-August 25 to early January 26 move. Whilst this may have in the past been useful in showing the lower bull channel line, as it was a coincident with the dark blue lower tine, both currently at 438, the dark blue middle tine did not do anything today at all. It's currently at 457. But I would keep a wary eye on the dark blue upper tine, which is currently at 478. However, I would still like to bring you a better idea of some of the larger forces at work here. Thus, please take a look at my longer term charts. Now, before we go any further, I would like, for the purposes of this discussion point right now, to set aside target X1 below at 335. Now, this relates to the lopsided head and shoulders top pattern dating from 2021 to 2023, and I'll refer to it should we get closer. But for now, as we're not, I'd like to concentrate on what new things we have for 2026. Thus, I said in my annual long-term video commentary published in January, and I quote, so what new feature have we seen developing through 2025? Well, I'd look to the whole 2023 today action as a possible double bottom in formation. But I think the market's having doubts about this pattern right now. You see, to form this, we'd have to move up towards the 2025 high, around the 61.8% absolute Fibonacci line, and the gold 5-year moving average. That one's currently at 431 and 3/4, and breach higher, which is a considerable order to fulfill. Yet in the meantime, we have the mauve 3-year moving average, and that's currently at 456 and a quarter, bearing down on the market. And as we saw in the past, or I saw in parts back in February 2025, this can be a significant bearish pressure. However, just that would not be enough for me. And this is where the action over November and December 2025 come in. Both these months have ended up as indecisive patterns, as if the market can see this mauve 3-year moving average bearing down on it is already flinching. I'm not sure at this stage whether prices could really handle this mauve 3-year moving average hitting and mixing with it, but we still have very few months. One final, I suppose, and indirectly related point to the double bottom idea, plus this also relates to an earlier target I spoke about. I said last year, so that's actually at the start of 2025. I said last year, and I quote, one housekeeping point and 1 point to watch out for. In housekeeping, I think by this time next year, we will have likely retired the secondary target X1 below, given the recent actions. But I've decided to keep this target X1 still on my monthly chart for one more year just in case. End of quote. Well, the key feature to note is that we have this month, with only 5 working days past, already breached the declining Mo 3-year moving average, a considerable achievement. This does not mean that we'll straight away go up to the 2025 high at 518 and 3/4, but it does mean that we are setting up the conditions to possibly do that. It all now depends if the market can stabilise over this breached 3-year moving average in the coming weeks, if not months. Kansas City wheat. The rise we saw since just before Christmas last year had been capped by various resistances, but it had continued to rise and formed a more than reasonable looking December 25 to mid-February 26 bright red bull channel, currently 548 1/4 to 581. 2 weeks ago, and again last week, the market breached the bright red upper bull channel line and tried to exploit the move higher, but it failed. It was only this week that we finally saw a sufficiently strong break higher. Prior to this, I said 2 weeks ago, and I quote, "A challenge up to the June last year high at 590.5. This now gives us the opportunity for targets above for this breakout, assuming of course it's not a false break, or of a primary target X up in the 609 area, and a secondary hard to reach target X1 up in the 632 area. Once we manage to pass June and April 2025 highs, well, we seem to be running up into a clear area, all the way up to the 38.2% Fibonacci line of the big old 2011 to 2019 move at 618. End of quote. This has spectacularly been the situation today, with prices shooting higher and reaching target X, then bypassing it and looking now to challenge the 38.2% Fibonacci line. We've basically closed above it and wondering if we're actually going to stabilise. Now beyond this, well, we have the March 25 high at 628 3/4 and the February 25 high at 642.5, and of course target X1 in between at 632. There are 2 other features to consider here today. First, the idea of a rounded bottom type pattern, something I floated on my daily chart before. Initially I thought from June 25 to date, but now I'm amending that to February 25 to date pattern. And I'll watch this with interest if prices rise to the February 25 high and the action we see there. Secondly, and it's an old technical analysis technique, but one that I recall worked well in the grains during the start of the Russo-Ukrainian war, back earlier this decade, and that is doubling, tripling, or even more of the bull channels. In this case specifically, the December 25 to early March 26 bull channel, and that's currently 548.5 to 581, which doubled up becomes currently 581 to 614, and which has seemingly, well, it did help cap today's actions for a while, but we've now tripled this higher, and that's currently 614 to 647, and that 647 gives us another topside resistance. Thank you for watching and listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpick and ADM Investor Services International Limited. And here comes the final important bit.